All right, Sunday, January 22, 2017. What I'm going to do is run through monthly charts over here at MRCI. It's a freebie, mrci.com under monthly charts. They're a service that does like seasonal type deals. They also give away a couple of trades, free ones every month. Take a quick look at them here. January free trades, it says the Canadian dollar here. Okay. What it's showing here is the yellow is kind of the ongoing process of the Canadian dollar. It has a spike, but it troughs through here in January. In the first quarter here, that the Canadian dollar does come down. The other one is wheat, okay, and this one looks like to be a spread of Kansas City wheat over May wheat for Chicago, and it's basically it shows the movement here. And when you click on the links, it says that the trades where we have down here 87, so it out of 15 years. Winners 13, losers 2 for 15. I always like to go back and look at the years that it didn't work out. Okay, so like on here, profit amount, they were down $1,500, and here 16, because everything goes in cycles. So if they got the negatives out of the way, wheat for this type of move, it's kind of like. If you're batting like 70%, and if you get a couple of them in a row, losers, then you're gonna, it's kind of like you look forward to the losers because then the gainers, coming up if you're basically consistent. I think what's it, 2 standard deviations or somewhere around there. It's even the machines at best are around 68 to 70%. So if you're batting, 7 out of 10 or 70 out of 100, then you're just as good as the machines. But remember that the machines are programmed logically, right? So it's the humans that I'm still shocked after the beginning of the year when I saw it, but the rest of the community didn't. So. In the equity market fall to buy the dip in January and February. All right. So those are the 2 on the wheat. And then I'll just eyeball quickly here on the Canadian dollar for the seasonal. Since the Canadian dollar is kind of throwing me for a loop here to be long or short, obviously it leans short, and which would also go along with my oil going back down to $45 a barrel. So here on the oil too, the same thing, 13 winners and 2 losers. I believe these guys are like $50 a month. I'll look at this kind of stuff, okay, but what happens is we've all seen this before. You see something where the trade is 100%, okay? You have to, everyone else knows these trades too, okay? Plus, you get the machines that read the trades too, right? They look at previous patterns and things of that nature. So I'll look at them to lean, but I won't put my hopes on it, okay? Kind of like, the peaks and grains in that will be around the 4th of July. But sometimes you might have where the peaks in that may come later, or the bottom might be in July. And that's where the human comes into the factor. I'll have the machine give me signals too, but then I'll just double check it just to see if I go along with it or not. It's kind of like going to these websites with where they have chat rooms and stuff. We know that day traders have a lifespan of 9 months, and for those trading Forex, 6 months. So if we know that they're all wrong, the majority of them are wrong anyway, you want to fade them. I look for people that I agree with, and then I'll follow them just to see if I'm in doubt on something. But most of the time it's how I read it. It's the psychology. It's what they say, it's not what they say, it's how they say it. All right. So we're just going to run through these real quick here. They're not logged. Okay, so the first thing is you have your S&P 500. Okay, so in my eyes, for you Elliott waivers, I'm looking at this pattern as a wave 4. Now that would also go along with if you go back to the 1930s for the bottom on the S&P. Okay, this is I look at this as a large wave 4. Now remember what we have going on here. We have basically the baby boomers kind of peaking out they should be, retiring. Okay. And so now you have this move after it. Now there's so much debt per capita. Okay. The inflation, the cost of things, when I started in the business, $1 billion was a lot of money for buying out a company. Now, when your grandkids come around, they don't want to be millionaires. Convince them that they want to be billionaires, because if they fail at 190 million, you still love them just as much. But my biggest concern is not correcting this last decade move, but correcting actually structurally the whole century. Okay, like I make jokes about it, but we haven't gotten around the depression thing. Okay, maybe we had a taste of it here in 09. I mean, we did some damage to the largest segment of the population, the baby boomers. Okay, and and all of this here is trillions of dollars that we've created to put into the system. But if we have, for future generations aren't very hopeful, and the egregious amount of money between the top and the bottom, history is in any indicator of what's going to happen down the road. It's not going to be pretty, So it's just that way. The Brits did it, the Portuguese, the Spanish, the Romans, you name it. Once we start doing the exact same thing behavior-wise, it doesn't end well. We rely on labor to, for our bottom line. So we all can't be hedge fund managers, right? All right, so on this here S&P 500, right? So I mean, just a quick eyeball, wave 1, 2, 3, 4, 5. So I'm looking at this as a wave 5. We also have the end of a cycle with bonds and stuff. If we do go into depression, then everyone will have to run back into debt. But now we're already at nearly zero on rates. All they're parking money at, they're just trying to cover inflation, So how I look at it is this is just a large, ABC of wave 4, and this is wave 5 coming off of the Great Depression low. Okay, and so that's why I'm just a wee bit cautious after, getting long, turning bullish down here and reestablishing it right here. So the thing is I'm cautious. It's one of those, it's like I said, I'm not looking for, a correction back to, I am at 1600. I'll take 1600, but it's the part of all of a sudden things get a little bit deeper here and it gets a little worse. This area right here is where the Chinese got involved with the World Trade Organization, and that's how we had this takeoff. Plus we also had the internet. So we need some sort of technological advance. Basically we have it. Everybody's going to be replaced. Either they're going to do their own labor, like at the grocery store, bag your own stuff, pay it, or the robot's going to do it. So we're definitely going to have a structure of our way of looking at stuff down the road. But that's how I'm leaning at this. That this is a wave 4, and this is the last hurrah. And when we roll over, we're going to have to figure something out here, because we've already thrown trillions at it to get us this. Now we have to have it. Come through, like I talked before, America's kind of slowing down on its birth rate. Mexico too, the planet may be peaking also. So this isn't just day-to-day living. It's kind of the grander picture of things. And the same type of deal here. It's not a logged chart, but basic same type of deal. 1, 2, 3, there's a long 3 move, 4, 5. We're dealing with higher interest rates, stronger dollar. There's a lot of larger cycles behind the scenes with the equities. Your Dow, which of course is one of my least favorite indexes, it had Polaroid in there, and it's just the hubris gets tossed away, and then new stuff shows up. So that's why indexes naturally go higher, because the hubris comes out and new stuff comes in. We got rid of Polaroid and put in Nike, whatever, you got me. I don't sit on the board when they put this stuff in, but it's the same type of deal here. The Dow is a little easier to manipulate. It's only 30 stocks, and it's price weighted compared to the S&P, where you actually have to, you have to move a lot of work there. It's capitalized weighted, the S&P. The Dow is, like I said, an easy manipulate. Here are the transports. Okay, transport's the same thing here too. I did, for those that have been following a while, I did like the transports when it kind of fell apart back in here. But now we're kind of stalling up here. Okay, so it's the longer cycle here, and like I said, I'm just cautious. Now you have the utilities. Okay, so the utilities, they're basically moving a big run. I'd cautioned last year that maybe this is a larger peak and a bigger cycle, because utilities, they're a dividend yielder. That's basically why you buy them. They're not really cap gains. They do flow with cyclical with the economy. But now that we have interest rates rising, I mean, just think if anything happens or whatever, all of a sudden we start dealing with higher, 8, 9, 10%. The utilities, you're not going to want them, because they're if you're buying them just for you for the yield, and you're getting twice as much buying government paper. And I, I'd mentioned before that, we have $60 trillion worth of wealth that the boomers have that'll be passed on to the future generations. Well, that'll come at any time. And I'm going to assume after the government takes the student loan money out of that pile, they're still going to indiscriminately spend. Okay. So you're going to have a whole bunch of Gen Xers and that who are going to basically, it'll be like winning the lottery, as the money gets, and that's what I think is going to drive the real inflation for the spending. And then we're back to the old, 70% of lottery winners are broke in 5 years. So, it's, they, mom, dad die, they leave you a couple million, whatever, woohoo, and that's where our inflation comes from. And we're going to raise rates, not because the economy is overheating production wise, GDP, it's because there's too much money out there. And that's, that's where I think our inflation is going to come in here. But like I said, I'm leaning that the utilities here, that this is some sort of, major high, compared to here, it goes to 400, the 200 cut in half, goes to 550, goes back to 275, cut in half. Well, what do we have here? 7, so it'd be 350 cut in half. It's, this is getting to be a little bit deeper here. And remember, most empires, they only last between 150 to 400 years, and we're at 240. We're long in the tooth for America. I mean, we're 84% service. So. And now that I pay my bills online and bag my own groceries and all this fun stuff, not too many of the whole service jobs. The Nikkei, all right, this is what happens when you tie in your real estate and the stock market here. They went bonkers on their real estate, and they're still paying for it. Basically here, this chart is marking time, and it's also price weighted, just like the Dow. I do talk about plain Nikkei futures. I think it's an easier read for technicals. It moves at $5 a point, just like the Dow futures. But all this time that they're marking is because people are in such debt because of the real estate, kind of like Florida in the 20s. They haven't been able to recover. And all they're doing is waiting for future generations to come along to assume more debt to keep the game going. And obviously this is what happens when you have a low birth rate, i.e. America, we're down to 1.88 kids. Mexico was 2 point something. In the 80s, they were at 6 point something kids. Now they're down to, Mexico is having the same amount of kids as Americans had in the 80s, and we're barely getting 2 kids out of there. And the Bureau of Labor Statistics says that the job growth in America is going to be 0.2% between now and 2025. And in the 80s, it was 3.8%. So how I kind of just shake the tree a little bit is I just talk about women having 0.2 kids. And that's the only way we're going to keep this thing, I'm convinced that kids born today will never have a job, that kind of thing. I'm sure Mad Dog blankety blank under Trump will find him a job, right? Over there. All right. So the Nikkei, I liked it when we bottomed down here. Okay, you get that special situation where the Nikkei was crap for 20, 30 years, whatever, and then the whole world bottoms out. The Nikkei was the one I really liked. My giddy greed came into it, but now we're kind of stalling out here. All right. It looks similar to like the dollar pattern of 1980, and here's where we're at. We're stalling out here. It is making a series of higher highs and higher lows. So, but for right now, it's stalling out here. But as time goes by, they've had enough generations to come through here, but they have a lot of structure problems too. They have a lot of let's just say we pay $1 for a bag of rice, they pay like 12. It's obscene, So they need, basically the planet really does need a depression. And so we can reset everything here, really, let's think about it. When I read a story about, somebody coming out of college and $350,000 worth of student loan, it's what, Obama was almost 50, before he was able to pay his off. So he'll be what, 12 years into a 30-year mortgage, and then Social Security will kick in. It's nuts. But the markets will take care of themselves. All right, the DAX, the same type of deal, swinging higher. Germany, I believe, is the world's #1 exporter. All right, so we're just a quick eyeball here. It says stall written all over it. Okay. That's like I said, I'm just running through these things. It broke out too, just like ours, and stalled. Okay. The NASDAQ to go along with the Russell, that's the phase that we're in. I'm kind of leaning that we're in the same type of phase that we had in the late 90s, but remember we had the baby boomers and their wealth piling in 2000, and then they went to buy their second home to retire in 2005 and got bent again, and now they're just working past retirement. So we have problems there. I'm sure the United States economy would be a lot better if we got rid of the baby boomers that should be retired but won't, because they need $10 for a copay. But the NASDAQ is basically what I'm aiming for because of the strong dollar. And, you want growth stocks, tiny stocks. This was before the whole Trump deal, because that's where it's at. All these smoke stocks and stuff, they're gonna have issues with the dollar. I believe short term, though, that the dollar is probably going to pull off. We're going to have equities roll over and interest rates come back down. It just seems like people want to kind of hide out for a little while and see how things kind of pan out here. And we're going to find out Monday morning when we all read about what executive orders he signed without reading, right? We watched him sign all these things without reading. Oh, it'll be fun. Okay, so, it's at a pretty good move all the way up here. Blah, blah, blah. This isn't, stuff comes and goes. Everything that helped to do this is pretty much gone, right? This is your whole .com stuff, but this whole mania is basically what we're trying to induce right now, is try to get that mania going. But there's, from what I'm eyeballing and all my charts and stuff, for what we've done in the market, we've pumped a ton of money into the market, and we're getting results, but I can't see it on the corporate profits and all this other fun stuff. Just, it's just pure manipulation. Take the low rates, buy back the stock, create a shortage of stock in the marketplace. People have to bid this stuff up. But now with rates turning over and the Fed tightening and said this stuff is all going to have to deal on its own. So I'm not saying, hey, it's a screamer here, but what I'm saying is, for the short term, watch the NASDAQ, because now the NASDAQ, remember, was the leader for the beginning of the year in 2016, and then it faltered, but now it's kind of poking its head through again. And now the Russell, which led us up after it had a big pullback, that's having problems. So we're basically rotating between who pokes their head up and who swipes the lower end. And here's our Russell. Same type of deal. It's the hubris comes out and new stuff comes in, but watch that Russell, because it's, I come across stocks that peaked in 13, 14, 15 all the time. So there's a lot of stuff going on behind the scenes compared to what is just in the index. And right, that's true. If the thing's a strong stock, it ends up in the index and everybody piles into it. Just like with the indexing, you continue to put money into index funds, they have to buy the stuff. That's what's in their charter. That's what they have to do. So even though Amazon still has a PE of 500 and something, whatever, they still have to buy the stuff. It works until it doesn't, kind of thing. But we're, for most bull markets, the business cycle used to be about 44 months. Now we're able to stretch it a little bit longer, till about 8 years. And 09 plus 8 is 17. It's a year ending in 7. So we'll see how this kind of pans out over the next couple of quarters. This is Australia here. So this one, the same type of pattern, looks like oil. Okay, this would be like the unwind in oil and coming up here. That's how I'm leaning at it. That Australia is, that they have real estate issues and they have blah blah blah. They haven't had a recession since Clinton was in office. That kind of stuff. All that energy gets stored up. It just keeps piling on and piling on and piling on. Commodity induced, coal and all that other fun stuff. If we have issues with China, which is a trading partner with Australia, if we're shaking the tree with Japan with the trade deal, we're basically just. We're just standing there in the refiner with a blowtorch just indiscriminately, just heating up pipes. That's all I don't understand why we'd want to do that, but that's just kind of the feel I get for it. All right, so now we're down to the volatility index on here. All right, so here, the whole thing, it's the whole black swan deal, right? So, but we talked about on the futures, if it gets below 15 and 14 and 13, you buy it and then sell it at 16, 17, 18. On the VIX deal, last time it spiked up. I was looking for 22 or 24 and it hit it. I'm gonna stretch it a little bit more this time and say 26. Okay, and then it comes down to, Kevin, when is this going to happen? Well, what I like is VXX. Okay, outside of the VIX futures, okay, you start with VIX futures if you can stomach it. Then you go to VXX, you can write naked puts to get involved. So it's kind of like every quarter. So if it drops, you can kind of average down on it. We're basically, this was 2007 down here. Okay, so it's one of those things that's the downside of greed. Sometimes you have to have the stomach to be able to hang in there when you're going in against something when it's really rosy. I mean, it's kind of like the last couple of videos where I sit there and talk about VIX and I go, even I was getting to the point of, how can you tell them, that, well, this is kind of flattening out a little bit here, and that's what it is. It bores them to death. And just like the bottom in gold, I talked about, I heard that the high and low in gold was 30 cents, and I'm like, that's what the spread is, and that was it. It just bores people to death. How many more times can you go after all those, VXX and whatever? Well, that's usually how it goes. Just one day they bored to death and it takes off, and that's what I'm looking for, because all we're seeing is poke our head forward and to a new high and then fall back in, poke our head and fall back in. It's almost like the pros are just tinkering with the market and the humans are just kind of, what do they call it? A fish boil. That's what it kind of feels like. It's almost lackadaisical. It's almost being toyed with, so, but here's the deal too. Remember, we're down to just a few money center banks, I think 3 or 4 brokerage firms. There are a lot of brokerage firms, but there's just a few. I mean, they all go golfing together. They all say, hey, if it dips, I'm not buying, and they don't buy. They just they go, okay, I'll sit on my hands for 9 months. Even though they are broker dealers and they're market makers and they have to buy and stuff, we already know what the humans are going to do, right? They're going to ride it all the way down, because this is how I look at the stock market. I'm looking for the Dow to get to 40,000 or whatever by the peak of the next real estate cycle, which is 2024. So I'm only looking for the stock market to double. So for me, if I can find it somewhere else, shorting oil, buying natural gas, buying wheat, shorting beans, whatever, that's all I'm looking for, a double, but in my case, I try and hope for the best too. So like before I said, I'm playing Trump as Richard Nixon, which is, it's all the other people around him. They know he's they know his character, and so it's kind of like stuff will go. I mean, when Donald is going to open his mouth and says, "I don't know," kind of like Reagan and Iran Contra, I don't know. Donald's definitely going to know he doesn't know. All right, so up to 30-year bonds. Okay, so post-Brexit high in bond prices and the low in rates, I think that's it historically. You can see that it's had a 30-year cycle. That's what we're working on now. So maybe we can get the Donald to come in here and start fanning the flames, because what we need interest rates to get spectacularly high again so we can start this 30-year cycle again. The interesting one was some of the paper, I think the front end paper peaked in like 2012, and 30 years on that one is 2042, and that's the next real estate cycle after the 2024 cycle in the United States. So it's just perfect timing. The whole everything centrally planned economy, it's pretty much in the cards here. So basically, how I think this could play out is like we get the dollar to come off, and then maybe a bounce in some of the commodities, but then the dollar goes back around and commodities bottom in 2007, and then 2017, and then 2018, we get a drought, which will naturally cause commodity prices to rise, not all of them, and then that would allow that would do the Fed thing. It's kind of like we get a bounce here in bonds, notes, and stuff. For the first 2 quarters, interest rates come off, the dollar comes off. Maybe, this is the odd time of the year for commodities to go up. Maybe gold to continue higher. But then all of a sudden reality kicks in, and then, there's a bumper crop of beans and corn and what have you, and then commodities just crater. And then that would cause, just the signs of that way. We begin to consume more. Kind of like 1987 to 88. Gasoline was 90 cents, 80 cents, and then 1987 stocks weren't running, and then that was the end of that story. But that was also the peak in real estate. 1987 was the peak in real estate. 2005, it's an 18-year cycle. 2024, 2042. I thought about running for president in 2040. We shall see, but just I'm looking for a bounce in bond prices here in debt for maybe the first couple of quarters, and then coming back down. Par on here is 6% at 100, so getting back to par, bonds have to get to here. Okay, but if we do run into a depression, they'll all run back into run back into bonds and stuff, and then we'd angle this way. But I'm going to assume we're just going to make a bear flag and then come down. So I guess the next target would be around 128, 130 level here. But when we get there, I'll discuss it. 10-year notes, the same thing. 10-year, if you just draw your trend line here, you can see it's correct. Same type of deal. Just draw it horizontal on here. Look for a bear flag and then come lower. Okay, because eventually we're going to have to crater the economy, and I expect one recession. Say if I do get my drought in 2018, 2019, hard winter, and they begin to tighten, then we go into a recession in 2020, and Donald is one and out. Even if it was Hillary, it's one and out. So the Donald's one and out, then the new person comes in. Equities come off hard, commodities are cratering. Because of higher rates and things that it's the cost to carry. When you do commodities, you have to, get the money from the bank. If it's 4, 5, 6%, and then your commodities are being stored, insurance, blah, 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 it doesn't make sense, right? So if commodities are depressed and stocks rolled over, what do you run into? You run them into housing. And that's the thing. 2020, the recession comes through, they drop rates, the people go running back into homes. Like right now, Trump signed the thing for a quarter point. Some people are going to be turned away from buying homes, because they can't afford the $30. If it costs a penny more than they don't have, that's not going to happen. That's the thing. So, there's the deal. Housing begins to stall in the first 2 quarters. Market rolls over and interest rates come down, to kind of fill that gap. Of what Trump signed on Friday indiscriminately. All right, and here's par on here, 100 down here. The contract used to be 8% and now it's 6%. Normalization is back to par. So after this bear flag, then, this is what we're working on. This is a 30-year cycle here in interest rates. 5 years, same thing. Every time we raise rates, it's at the front end, like T-bills, euro dollars, which are deposits, like T-bills in Europe. So 2s and 5s and things that's the front end that will feel it the most. So you want to short the 2s and 5s. I did notice a chart. I didn't post it, but I did it with 2s over 10s. And it was multi-month type of thing, and it's back into that upper range, where we're at a stall between the spread between 2s and 10s, like the third time in 20 years or some number, whatever, So that's kind of helps lean for the bounce type deal. But if people become unglued and run into equities and interest rates drop, then all of a sudden things begin to slide a lot harder. Okay. Because this is the bond market's a large market, and it's worse. I'd rather see a bounce, and then I like the gradual thing. I don't like to see the old, just it falls out of bed for whatever reason. Whatever they want to react to. This is actually the big money maker. Here's the euro dollars on the short side. Like in the next video, when I run through the futures, this is where it's at. Okay, so these are fat contracts with little margins, like $5 million in margins, like $500. Okay, but I'm looking for euro dollars to get back into this area, which is like 95, so it'd be 5% overnight rates, okay? And 5%, and then say 5% on the long bond would make, what's that, 6 3/4, would make home mortgages a little under 7. And I talked about the student loans at 7% right now, so banks, for some reason, they love to get to that 8% mark, okay? So euro dollars is it. So if we do see some damage come into the equity side of things and people run back into euros, I would expect it to be some serious short covering. And then for those of you who want to get in it, but like I said before, it's little margin on the big contract because, span, that's for risk from the CME in that. Okay, so when you have multiple years of low IV, implied volatility, the margins are lower, okay? And all that does is creates higher volatility, you know, and 1990 when I was a broker, commodities broker, we had the Gulf War. Margin went to 100% of the value of oil, and oil just cratered. Because now, you know, one day you're putting up $5,000, and then the next day you have to put up 20 grand. Well, you're going to get forced selling, just like with the Hunts and silver. You know, you can only sell. And that's what they did. So, but this is, you know, this is we're rolling it over here. So any type of bounce in euro dollars, you wanna do the short. But if you're on the short side now, be wary of a mad dash run back into it. And it's basically just because of I don't see much money flow in there right now. Everyone's content. Oh, we're gonna get 3. See, I told you know this is the second rate hike, right? So all of a sudden they're like, oh, we're talking 3 more. Well, what happens if that doesn't happen until, you know, later in the year kind of thing, if we kind of, you know, stall here. Gold, I talked about if it lost whatever, 1250, it's on its way down here to, I think it was right down here, 681 or something. This is the next level I'm looking for. Then there was it stalled here, and I saw the pattern from 1985 to 87, okay, and it actually did trade higher, okay. So I look at gold as in a bear market, but I could, you know, if this played out like 85 to 87, then we could get a C wave up to 1500. It's not on this chart, but it has to clear. I think it put down 1220 first, and we're down below, we're plus or minus around 12. So even though I said that there's that possibility, it still has, you know, it still has to make the baby steps here, because if rates do, if bonds do, you know, everything craters, the dollar is just going to take off and gold is just going to fall apart. Okay. So like I said, if, you know, if stocks roll over, dollar comes off, bonds go up, notes and interest rates come down, gold will probably poke its head up. Okay. Silver, industrial metal, I'm just waiting for it down here again, so I can start buying bars. When I talk about dead money, this is what it is, because everyone was back into equities here, you know. Silver's not so hot for right now. I mean, you know, it's platinum. We'll go through it. On balance volume's a little bit better. Silver, I mean, yeah. See, for me, it's one of these where, you know, I'm watching for it to do, you know, break the trend line here and take off. This is just, it's, to me, it weighs the risk side of things. You know, I'm looking for it to be dead here. This is when I want to accumulate. I don't want to have to kind of play this little silly game. So I usually pass. Where are we at? 85 to 87. So this would be the same type of deal. It finds a bottom and goes up. Was gold on that one? The previous one? Gold, yeah. So where's 85, 87? Kind of like here. It was still in a bear market, and it continued lower for the next 15 years. Okay, so basically I'm looking at just this, you know, this type of move, you know, we got this much, but it's kind of stalled out here. So it's like, well, you got to have an ABC wave higher. And same thing with silver, you know, possibly being a C wave. How they spin it too, you know, oh, interest rates are hard. Oh, we have inflation, mad, whatever, and they go running into it. But it's kind of like, yeah, you might see 25, but more than likely you'll see $5. So it's like, you know, do you want to play it for, you know, $7 on the upside or $20 on the downside? You know, that's kind of how I weigh it. Platinum doesn't show on here, but the unbalanced volume was pretty much buried. And, you know, the previous high, you know, stalled at it. So this is one of those that we may, you know, how far down do we have to dig to get to this stuff, you know, compared to like oil and, you know what I'm saying? You know, at some point there will be, you know, this was all in the 70s at $200 and then $400, you know, $600, $800. There's maybe some natural inflation here, you know, because it has intrinsic value. You know, it's not like stocks. You know, stocks are basically, all of them are valued at a penny a share. Palladium, you know, at $100. Once it took off, it never came back. Oh, we could have a Head and Shoulders here in palladium. Same, you know, it's the same type of deal. You know, it's up here. What happens? They mine it. Then you have too much, and it comes down. It's kind of like, you know, how I'm looking at all these commodities. What's going to happen? You know, say after the drought and whatever, when we go into a recession. You know, how is Amazon.com going to handle a recession? Copper, you know, here was the happy place all through the 70s, and it took off, came back down. So it can go back down below $1.50, and it did. Oil did, right? Oil, when it had to unwind, got down to this level. Maybe this is just a bounce in copper here, oversold bounce. And then I'm leaning this way. I'd rather prefer to avoid copper, even if I think it's going to go to $3 or $3.20 or whatever. I'd rather lean that it comes back down this way, and then maybe I'd be interested. But I'm not a big thing of copper. I prefer, you know, if I have to be a cheapskate, I'll go and, you know, it physically buy silver, that kind of thing. Swiss franc, looks like we're going to get some sort of bounce here, but I prefer to play the short side on this one here. You know, this high was 11 deviations from the norm. So it's the short side here is what I like on the Swiss franc. After a bounce, euro, short term, you know, I think that the dollar continues that we'll probably get a bounce in the euro. You know, we play the sideways jab thing again. Okay, this is the third attempt to crack through here. We'll say 104, 105. Cracks, fails to do so, gets a reverse. So we should go and poke through the other side. So, I mean, how many people are looking at, you know, 110, 111, 112 for the euro? You know, but it all comes down to the next couple of weeks to see how stocks, equities, and bond, you know, because what do they call that love affair? The honeymoon is over, you know. Japanese yen, the carry trade on that. The carry trade on the Japanese yen. I was some earlier videos last year. I talked about that the U.S. dollar yen goes substantially higher. We're talking like 180 in that, and that would mean that this would have to crack and come lower. But for right now, I'm leaning that pair U.S. dollar and that 118 level will hold for now, and 114 did hold. You know, it's kind of like, are we going to go see 109 first or 119? And that's kind of how I'm playing this here. But the Japanese yen it's still being used on the carry trade on here. So like I said, I think, you know, in my eyes, I'm looking for, you know, the end game and the long dollar trade for right now. Because of when we do hit the recession, we have to pull back on the money and then, or the rates, and then the money is going to come off too. Let's just say a lot of it's already baked in there. But you know, for afterwards, you know, once the real inflation starts kicking in, then I could see this thing coming off, and then the dollar going back to this is a pretty strong dollar. We had double-digit rates, but I just got done talking about, you know, I'm talking, you know, 6, 7, 8% getting back to normal. Then now you have to become abnormal, which I already am. You know, and so, you know, it's, you know, we saw the Japanese stock market, you know, so this is a pretty healthy move here in the yen. So, you know, that may be it. This was a pretty good move in the 80s. Then the United States raised interest rates. It was a pretty good move here, and then we raised interest rates. The other flip side is remember at one time in the 90s and that Japan owned the majority of our debt. Well, if interest rates go higher here, the debt goes down. So they're going to have issues with that. This all came about because of our bond, you know, with bonds and stuff. They had capital gains in bonds. Now they're having capital losses. So that's going to affect their economy. But a lower yen does help out with their stock market. British pound. Okay, here we go. All right, so we got our, what's that? We're down to like a 33-year low or somewhere in there. Pretty low. Unfortunately, it's a fiat currency. And the British, this used to be at $4, I think, in the 30s and 40s or whatever. So their money has lost 75% of its, the British Empire, right? American Empire, it'll all look the same thing. But for me, people are going to be targeting, parity, and I'm looking for it as if it fails, what do we have? Like the crosses, the pound Aussie, the pound Kiwi. I like the crosses that way, but I'm just keeping my eye on it, just like the Mexican peso. You're getting these, just like with natural gas. Here's a 35-year low. Look at what happened here. This is the same type of deal where America had high interest rates, and then Saudi Arabia flooded the market with oil. It's at marked a bottom, and the pound went from $1, to $1.80. It doubled in 4 years. Okay, I don't know about you forex traders, but if you have a currency double, I think that's swell, right? You start talking, 6,000 pips. Well, what's a double? 100% times 50 to 1 leverage. So it's at 50 times your money. 50 times your money in what's that? 4 years, 5 years, 6 years. Each your own. And I'm not saying that, the pound's going to go from 120 back to 170, but it's shown it in the past, that kind of thing. Here was the move in the stock market here from 140 to 230. So that was almost a 100, move on it. So, that's whatever, so, 25 times your money in 5 years. Okay. And all I have to do, you put it on and you walk away, right? That's pretty much. So if I'm going to have to eyeball something, I'll eyeball natty gas, British pounds, Mexican peso, and then the index futures, and then wait for, someone to say soybeans are at a 25-year low. And then I'll get involved there. You only get about 3 or 4 good trades a year. I'm kind of leaning towards the Mexican peso first. And then for this year, Mexican peso. And I'll watch the British pound. What else is there? A lot of them. See, the deal is last year we had the moves, so this year it's like, well, where are the moves? It's like, well, even if they take half back, it's still good. If you make $200 on gold, you did, if it was 400 last year and 200 this year, you should complain, right? Canadian dollar, this is the same type of pattern. Here's 85 to 90. It came off the low. This looks like we're working on a flag and a trade higher to like maybe 80, 85, or, somewhere in this area is how I'm going to lean, just like this here. And it was the same type deal. Commodities bottomed in 87, and then all of a sudden 88, we got a drought, and then we got a Gulf War, and then the recession, and then, finally commodities bottomed from the 80s, from 1980 high. So it took 17 years, and then it took 22, 23 for the Canadian dollar finally at the bottom, and it took off. Do I think the Canadian dollar is going to happen here? Well, talk to me in, what is that, 23 years? 20, yeah, right after the real estate peak. Well, then we'll talk about putting on a long-term position. In 8 years, in 8 years, or what are we at, 7 years? Ooh, good, it's getting closer. In 7 years, if it's under 70, start accumulating a position for this. That's how I look at it. Aussie dollar, same thing. It's kind of in the middle. Yeah, it's just kind of pass. It's that kind of thing. Because I'm looking for, some sort of the major turns are what I'm looking for. Just sit here and wait. Just keep trailing this thing down until you get stuck in. But I knew that this commodity cycle. I wrote all about the commodities and at Misinvest Stocks. Bulletin board, net news. Oh wow, it's been a while. Yeah, Usenet. There we go. Holy buckets! Wow, I guess it's been 17 years. Back in here about commodities. I was looking for. What was it? $1,200 gold, $60 oil, $18 beans. What I didn't do though was add the inflation into the price. So when oil, $60 oil, I mean, it only got into 40, and so I said, hey, it's going to go to 60. And of course I take a lot of shit. That is a technical term, mirrored. For this here, but that's what it is. That's what I do. I'm a technician. I'm like your doctor. I open up the chart and I go, you will actually survive. You will have some hypertension. When it's all good. I better fix that squeak. All right, so that's the CAD or Aussie. So yeah, it's just whatever we get here, and then just it'll roll over. Mexican peso, right? So look at this thing. La 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 la. How much more can it do? And that's the other one too. Is what's going to happen here? We've all been around long enough to know that we've seen pesos go from, what's it, 1,000, 2,000, 3,000 pesos to the dollar, blah, blah, blah. Now we're getting, our trade, our contraband trade through, so, we're going to see a lot of different changes going on here. I just think that it's just too much. I mean, you get how much lower can the peso go when you got the devil, and the blah, 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 blah. You're just waiting for the reversal. That's all and then that's over with. It's done falling. Then it goes the other way, that kind of thing. Dollar. Okay. So is the other one better? The other one's better, but we'll start here first. So what did we have? We had kind of a sideways pattern here and we poked down through. All right. So in my eyes, this was the long on the dollar. Go back and look. Pound, 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 pound. Then we finally get the obvious with interest rates. And now it's really getting obvious, okay? But here we are about, we're at the 103 to 105. It's stalled here on the way down. So the deal here is if the dollar comes back in, we're going to have a lot of unwinding of a lot of stuff. And I think that's probably what we're going to have go on here. I looked at sugar. I looked at a few other commodities. I think we're going to have some sort of unwinding here, probably just this year, and then Mother Nature needs to kick in. But you can see up in here, here it's stalled. Here it's 80. Well, let's go back. If I'm playing 85 to 87, 88, here's our little deal. It stalls, comes back through. 1990, so the dollar came off there, and then it took off with the bull market and higher rates and balanced budget and all that fun stuff here. And then it came off with 9/11, interest rates going to a 90-year low, and then it bottomed, and now we're going the other way. So, like I said, I'm looking for an end game in the dollar. Do I think it's going to go up here? Possibly, eventually. We talked about the pound. That may be it. And then this was under Clinton. So, for me, I'll just target 120 for now. But short term, I think we're going to come back in. Wow, 88. That was the drought. And then we also, interest rates. Okay. But this pattern, these little lows here, okay, dropped interest rates. We started raising rates in 94. So we came off again, and then it came back in. Okay, so we had to have 5 years down. All right, that's what we got going on here. So swing. All right. So basically, the whole futures game again, where, the dollar gets under 100, buy at 99, 98, 97, 96, blah, blah, blah. And then the swing the other way is 110. That's kind of how I'd kind of play it. I don't know where it's going to stall when it comes back below 100. I mean, it still has to come back below 100. We did get close, right? Where we close at 174. And I think we poked our nose under there. It's a good round number. So we'll see, interest rates come off, the dollar comes down, stocks come down, bonds go up. And we're going to see about that here. Crude oil, we know there's a lot of longs there. There haven't been that many longs since up here. So I'm looking for oil to come back down. Here's a good happy area. Back under 40. Stop right now. The target's 45 for now, and that kind of thing, crazy. These are going to be some serious numbers that won't be hit in a lifetime. Brent Oil, the same thing. You know, it's to my eyes, it's done. I'll wait till everybody's bored of oil. Same type of deal with the products, heating oil, you know, gasoline, you know, same type of deal. You know, these highs, they're going to be gone for a while. You have to work on some sort of low. Gasoline. It actually says we're going to add 50% to our population and actually use less gasoline. So this will be an interesting coming 20 years. Anti-gas we looked at this morning, saying, you know, bang off, come back, bang off, come back, bang off, come back, and then, ooh, here's the first run, second run, third run, fourth run. Now we have a larger sideways degree pattern. Here's 6. You know, here's 8. You know, 8. Like I said, 7.5. As wherever it lands, I'm shooting for 7.5. You know, 8's a pretty good number. You know, you can just because all of a sudden you're on your own kind of thing. You know. But look at where it's at. I mean, how can you not I wait for this thing to happen, especially if you get a pullback. Cows, same type of deal. I just think it's a bear market type deal and then continuation here. Cows are going to have, you know, unless, of course, we convince India to cheeseburger. Quick story, I was waiting tables in high school. Indian exchange student came in and ordered a bacon double cheeseburger, and I paused there when and I realized what was going on. It was a generational thing. So, you know, you have women who burn bras. I mean, it's, you know, well, we're supposed to eat what? Folks eat, not meat on Friday, so it's clam chowder, but yet during Lent, right? Eat clam chowder during Lent, but yet now it's all year round. So that idea of the Lord thing or whatever, of eating, you know, following your religious beliefs, it kind of got muddled in the system, and now clam chowder every Friday. You know, so you know what I'm saying, but I mean, you know, let's think this one through here on cows. You know, they're just nasty animals to the environment right now. You know, maybe 100 years ago, not so bad. At the turn of last century, America's pig eaters. Sinclair's book really put the damper on people eating ground beef. And the White Castle guy, he got together with the bun guy at the 1920s. There's a World Trade or World's Fair. They got together and convinced them, and then it was the whole hamburger thing. Now Americans eat 3 hamburgers a week. All right, so the deal here is, you know, what happens if we convince India to start eating beef? You know, like I said, you know, we're only supposed to eat clam chowder over Lent, right? As you can tell, I'm not Catholic. So. I know what I can say. What's the one that believes that there's a soul in a rock? Druid? No. Pagan? Yeah, we'll go pagan. Yeah, Viking type thing, way before all the Judeo-Christian religions. That should pretty much freak people out. oh, I go back way before all you guys. All right, try not to lose any more members, Kev. All right, so, all right. Live cows, yeah, live cows, just a bear market, and then blah, 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 back to 80 cents. Strong dollar, right? We can't export this stuff. We're going to start importing our beef from New Zealand. That's how it works. What, you know, it cost me $1 to make it here in America, but 80 cents to get it from New Zealand. Buy it from New Zealand. It's like my garlic. It comes from China. It has to drive through Gilroy to get here. Look, I don't know. Somebody wants a Lamborghini more than me, kind of thing, you know. So my garlic comes from China. All right, feeder cows, same type of deal. Feeder cows are a lot lower here than live cows. So there may be a spread between buy feeders and sell live. Hogs, this one down here was the precursor. 1998 hogs got to like a quarter, 20 cents. Lowest price since the Great Depression. So for all of you that say, hey, silver can't go back to 35 cents an ounce, yes, it can. Just throw yourself a little depression into this whole thing. You know, America's 20% of the world's economy, GDP-wise. We're just waiting to pull the plug on it. That's all we're doing. You know, we're trying real hard to keep this thing afloat. You know, 6-figure student debt. It's all over with in my eyes. We're just all basically lying to ourselves about what's coming next. You know, we don't have enough hospitals. All these nurses are running in to go be nurses, and they're not. Guys like me, I'm not going to invest in hospitals. What am I going to do? Turn it into condos once the baby boomers are gone? No. All these nurses are going to be home health care aides. It costs $200 a day to put somebody in a nursing home. For $12 an hour, I can send somebody to somebody's home for what's at $96 a day. So, and then the people want to live at home. They want to die at home anyway, right? So basically everybody's going to get their own personal nurse, kind of like on Cannon and what was it, Barnaby Jones and all those rich people that are drinking scotch at 10 in the morning. Miss those TV shows, right? It's 10 in the morning. You want to drink, you know. That's what it was like in the 60s and 70s and that. But they all had their own personal nurses, and that's what we're going to do. We're not going to build the hospitals. We're going to send some person to their home to take care of them, like cleaning, cooking, for $12 an hour. Go look to the Bureau of Labor Statistics, and that's exactly what we're doing. We're telling them to go in and be nurses and stuff, take on the debt, and tell them that they're going to make $70,000 a year. But just like everything else, not everyone can be a CEO, and not everyone can be a hedge fund manager. The nurses, the majority of the nurses today are going to be home health care aides. I can't remember. There's one and another. The one makes $1 more than the other. I think they could probably shoot up and check insulin and pills and stuff of that nature. That's where we're headed, folks. And not to pop anybody's bubble, but when those all popped up, I'm like, okay. And then I realized, oh, this is what we're doing. Milk does a body good. It's kind of stalling out here. So you milk guys with contracts, I'd kind of maybe do a little hedging on here. It did get down to this 12 area or whatever. Last time I was asked was up in here. The other thing too is I don't know how a drought works out. So you might be able to get 19 or whatever. And the other one too is I don't know how you know, if our POTUS doesn't want to sell homes, I don't think he's going to want to. Oh, he'll definitely sell farms if he pulls the plug on you know, subsidies and stuff. And it's just one big game, right? See who can drive into the ground first so we can buy their assets at 10 cents on the dollar. That's all we're doing. That's all we're doing. We're just trying to let everybody run around and build it up for a decade, and then we take it away from them. Humanity at its finest. Okay, so we're gonna, you know, think about this with the drought. Where we go, 88 on here? No, 96. Okay, so we did get a spike in milk prices, and I'm looking for that. So, you know, maybe hedge a third here, hedge a third at 19, and then possibly get 22. I'll save that for my milk guy in Chicago. All right, beans. I'm looking for beans to come off here. The bodies are in it. They're anticipating something happening. Okay, follow me on beans. This is how I got started here. This is where I started watching the markets and the weather and stuff. I was, I think, 9 years old. But I remember going to Lake Oahe in Mobridge, South Dakota in '76, going fishing. And as I say, I can walk across the thing. Okay, so there was a huge drought in '76. So I remember, you know, that's actually where I saw Rocky too, by the way. '77, I remember the corn in Rochester, Minnesota being like 10 feet tall. Okay, I remember that stuff, '78 and that. Okay, so back to beans here. So beans, we had a run here where the Russians came in and bought our stuff. They had a bad crop. Okay. Then '73, '74, I think the Hunts got in there. We also had issues with NIXON, the dollar coming off, the gold standard, things of that nature. bottom here, then they went up again. But what I'm pointing out, it's like waves in the ocean. So before 1988, all I saw in beans was this. We didn't have stock index futures yet. Beans were the Rolls Royce. You buy at $6, you sell at $8, you make 10 grand on 2 grand. What is that? 5 times your money. And that's just straight up. You buy at 6 and sell it at 8. Well, of course, you get $10 here, right? 88. I remember that drought. It was droughtish. Okay, so you see it. You have like what 80, 84, 88. So you should get 92, right? Didn't happen here. We didn't get it. The weather wasn't there. But 96, we did get it. We didn't get 10, but we got 9. But we also had the dollar was taken off too. All right. Plus the other one is, if everybody's doing the whole .com thing, how do you convince them to buy beans, right? When it gets spiky, that's when the herd gets involved. Then commodities bottomed down here. Okay, this is the secular cycle of commodities, right? Bottom. We get our first swing, brother related, the whole inflation. Hey, what do you know? Kevin in November 2001 said we're going to see $18 beans, and we did. Yeah. Okay, so back to this. So now we have the bodies and beans right here. What I'm looking for and everything is that it doesn't show up and beans just come flying all the way back down to $6. That's what I'm aiming for here. I'm just waiting for the bull market to start again. Now, I'm not in the Midwest anymore, so I kind of have to go off the chart. So it's kind of like it's an iffy thing. It's kind of like this here where it comes down to this level and holds, and then runs up, comes down to holds. But if it fails, it'll be just a precipitous decline. I'm going to see it play out. If they're going to unwind oil, and if they're going to unwind natural gas, they're going to unwind beans. The possibility of unwinding, there's not as much as in corn. The bodies are beginning to roll into wheat. Like I said, I'm leaning here that we begin to get a bunch of frays and people start pulling on it, and we get a whole bunch of unwinding, especially if we're going to go into a depression, because that's what you said, Kev. Everything goes down to zero in a depression because they sell everything they have to hold on to their home shelter. I'm not leaning for depression, but all I'm saying is that we haven't fixed that. We have recessions. A depression is just one that lasts a little longer, so all right. But still 90% or 70% of the country was still working, so but yeah, if anything cracks on the beans, I expect it to come back down to, if it loses, what do we have? $9. No, I think I said $9.80. Then there's $8.50. I wrote about $8.50. I'll go back to the $6, because remember we have that natural inflation in there too. But if hogs can go down to depression prices, beans and stuff can all do that too. Yeah, there are more bodies on the planet, but what happens if we have some sort of grain embargo or whatever, or things just don't work out? Plus that works the other way too, where you have scarcity. I don't know what kind of games these guys are going to be playing out of Washington, but we definitely know that these guys are going to be playing games. It's just what happens when, they play their games. Why not, right? At one time, I thought I could manage continents. All right. That was when I was going to run for the Senate. And then I realized, you don't get your freedom, really. So then I said, you know what? I'll just be a libertarian. I'll be an independent. So I'll that way, half the side won't hate me and the other side love me. It's either they're all with me or they're all against me, right? Libertarian. I don't care what you do, just don't get it on me. All right, so here we got bean meal. You can see a little more waves in the ocean here, right? Same type of deal. It's all cyclical. All cyclical. All right, same type of deal. If it loses this, just let it come on back down. Under 250, then I'd probably begin to, line something up, deep pockets type thing, to try and start putting on a position, waiting for the old swingaroo here, because it is waves in the ocean. You're just waiting for the setup. Bean oil, a little bit different than beans, same type of swing and stuff. Remember, you have canola in Canada and blah, blah, blah. You have palm kernel oil and what other derivatives do we have of that? Soybean, sunflower, canola, rapeseed. Wow. I don't care. Is it going up, down, or sideways? That's all I care about. Bean oil back down to 20. Oh, hey, if you like scams and stuff, go punch up salad oil scandal. That was a good one. That's some ingenious thinking there. Yeah, salad oil scandal. Corn, same type of deal. You know, I guess it's a little closer here at $3. You know, yeah, anything under $3 in corn, then start establishing a position. I mean, before this time period here, you know, I have to say that yes, this is a splash on the chart, but this is similar to like when oil hit $100 a barrel back in 1864-5. Or cotton hitting $1 during the Civil War and then not hitting it again until the late 90s. You know, this stuff here these prices are, I think, going to hold on for maybe a century here. That's how I look at it. I mean, think about it. We've thrown, you know, you ran to ZERP. So, you know, if this is inflation related, whatever, that's going to hold in. Go back to more normal times, you know, $3, below $3 in corn. It used to be $2.50, but $3, anything under $3, begin to start putting on a position. You know, it's $5,000 a buck. You know, I usually, usually when I poke students, I send them over to corn first. They can't get into too much trouble. You know, plus or minus $200 to $400 a day kind of thing, you know, that kind of deal. Or no, 4 cents. So it'd be $200 a day plus, you know, to get your feet wet, you know, because you have to lose your first steak, right? So you go, oh, this isn't as easy as I thought. And it's like, yeah, pretty much. And it comes down to how long do you want to hold your losses for, you know? All right. Yeah, $3. Okay, it's cool. Wheat. See, now here, remember I'm getting all giddy under 4, you know, just like up here with corn at 3. So we may have something here. Maybe $1 or $2 higher, but the other one too is that, you know, it's like the bodies are coming into it. If it doesn't hold it, it cracks. What do they call it? Collateral damage, you know, and then you have other countries. You have Canada, and Australia and China and Russia and all that stuff. You know, when it's good, it's good, and when it's bad, it's bad. You know, whole hemisphere is bad. So, you know, wheat's not as, you know, cyclical, spiky as beans. But you know, when you get down to this, where all of a sudden you go, hey, look, it's at a 12-year low, or 13 or 14 or 15, then it perks up my ears. I'll sit around and watch this. You know, but here it just does look like it might stall into these areas if we do get some sort of bounce. But anything under, you know, down under this $4, I want to start establishing a long position. Kansas City wheat, we saw that spread that came down into the meaty area. See, so that one. I don't have access, I believe, on my platform. And that kind of causes a little issues to get into these opportunities. So that's why you have multiple brokerage firms besides multiple brokers. The one part is you can't, usually if you have more firms, you can't turn your account into zero. And then also you have to have access to the markets. And then if one of the brokers goes belly up, John Corazine, you know, or they steal the money, John Corazine, or whatever, at least you have some money stocked, you know, stowed away somewhere else. All right, so it's, you know, same thing. Kansas City wheat, you know, it's you know, got back into a meaty area, you know, and we're getting a bounce here, so. And wheat's different than the other, you know, wheat you can throw out of a plane and plant it, grow anywhere kind of thing. Here's Minneapolis wheat. This guy here, I'll tell you that story another time, but this is what happens when you can't make delivery and you have to go to market. Get a little swing here too. So wheat looks pretty good here. Oats is usually the leader in all of these here. Minnesota's the #1 producer of oats, but it's already up here. Oh, I'd like it to come down one more time. One more time. Keep an eyeball on oats. Under 2. I did get to $1.50, $1.60. We do have access to oats. It's a little on the thin side, but it's it's $5,000 a dollar too here, 200%, 200%, that kind of thing. If you're lucky enough to snag it on minimum margin, rice, 3/4 of the world eats rice a day. There has been some fuddy-duddy stuff. People paying everybody. It just seems like it's all corrupt now. Half the contracts are settled in cash, so you can't even corner the market. You want to take delivery, they just give you cash. I mean, it's insane. But rice is pretty much a decent area here. I don't think I've ever played rice. I think it's because I probably didn't have access to it or whatever. But remember, we do produce some, a decent amount of rice and stuff. Drought related. 12 here. I guess I'll have to treat rice like milk. Get down to eight down here. $8 a hundredweight. That would, yeah. But I'll pass. Canola, Canada, it's up here. I'd probably short it. Just looking at it, kind of short it. Short it back down to 3.5, 4. OJ, yeah, that talked late last year, October, November, something. Sell. The only thing we got going on now with this is occasionally Florida I would play long March futures. It's a thin contract. So maybe if you save some money and can't go to Vegas now, maybe you want to buy, some calls here to see if we saw the insanity in oil and stuff. It can happen with OJ. Stuff comes from South America, so, it's one of it's all over the board. If everybody's falling out of OJ and we're not through the season yet, Florida freeze, wee, and all of a sudden it goes to, this is in the 70s. Here was the pattern. It couldn't get, over 60 cents. And then it was, 120, 140, and then it got up to $2, and then we poked its head up to $2.35 a pound. You never know. You never know on this stuff, especially it's in a thin market, just complete freaking insanity. You saw with what happened with Minnesota, Minneapolis wheat. Okay, like here's complete freaking insanity here. This is sugar party. And they gave it another go here. This is 1980. We also had a grain embargo and stuff. That was backdoor dealing with the Russians. We'd sell it to the Russians, but it'd have to go through Rotterdam, and then nothing. Hey, maybe we'll get the Trumpster to start cutting sugar subsidies to old time families. Right? All right. It does have a decent setup for right now. But short term, we may run into some problems with sugar. But I would expect it, because what's going to happen is there's only going to be a few markets. This isn't broad-based secular run like we had from the aughts, okay? These are things that are going to do it on its own, all right? So, sugar to go back up to 40 cents a pound in that, it's going to be weather related. You're going to have all this money that's running around chasing after this stuff. And it's going to be selective bull markets, kind of like coffee. It was an oddball one, South America oddball one. But, somewhere between $1.50 is pretty good in coffee. But this was during a recession here. Maybe coffee will come back under $1 during the next recession. Then I'd be interested, right? You're looking for these opportunities here. The low risk, All right, cocoa. So your bigger picture, here's a little high on cocoa up in here, right? You know, you go from 5,500 a ton to 1,500 and chop, 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 chop. You get a little bit of a run. And now we're down to here. You know, we're in an oversold area. I mean, think about this here is, you know, how many, what, 5, 6, 7 billion people on the planet here. And now you're working on, you know, 7, 8, 9 billion people on it. Can't get anywhere. So this is, you know, there's still real time, you know, supply and demand going on here. Just draw your little trend line underneath here. It cracked it, so now you're just working the other way. I remember playing cocoa down here. Where was it? What was it? Where was it? Oh, it was over here. Yes, it was in here. Cocoa came off the low, came out. The 90s were a good time. Japanese yen 120. I snagged a few of them back then. All right, and the cocoa one here broke out to a 9-year high, traded up and just rolled over. And it's like, what? No. And you're sitting here going, oh, you know, you're holding on, you know, blah, blah, breaks out, and then roll over. I'm sure a few other people are going, hey, oh, now I see the head and shoulders. You know, trying to find a bottom. And I'm like, well, maybe down here. You know, cocoa could be cut in half again before you think about it. You know, what? Yeah, I don't know. You know, I don't know. You know, it's finding a support level here. It's not my cup of tea. I'm looking for, you know, when nobody wants it, you know, well, you know, come down here. Cocoa comes down to like 500, 600, 700 a ton. It's at a 40-year low. Guess who's going to try and buy, you know, the Ivory Coast? Me. You know, that's how I look at it. Lumber, huh? Well, lumber seems to be holding its own for the last few years here. So I'm going to guess, because the little humans here keep cutting down all the trees and planting McMansions, that we have a situation where lumber's in a new trading range. I won't say for eternity, but it's definitely... we did get an unwind here. It's a thin one too, but it's just one of those where it's like in relationship to where has it been in the past. What's that, $5 a foot? $5 a foot for lumber? Yikes. Oh, that'll definitely put the squash on homes, right? All right, so $250 a foot. I don't know how lumber goes. Yeah, I just pass, but it's just kind of seeing about the cyclicality of it. Swings. It's a thin one. I think lumber went limit up like 17 days in a row or something, or limit down. You don't want that to have happen to your account, or you do if you want it. Oh yes, here we go. Cotton. This would be our little boys at Glencore. Glencore guys kind of just didn't, you know, kind of held on to their shorts, and it cost them $2 billion in a bankruptcy. And now cotton's down here again, right? So it's 80 cents, whatever, cotton. So, you know, it's here. It's kind of short term. The bodies are in there. It's not, you know, once again, this is a special situation where morons didn't have their stops in, but they did have multiple billions in their account to keep this thing alive. You know, like I said earlier, you never know if it's like, well, I'll just blow up the firm and stuff and we'll just pocket the money and screw the investors. Oh, the humanity. All right, so, and this was the first time cotton hit $1 pound since the Civil War. So there we are. Cotton can be limit up, limit down, limit up in the same day, and you shouldn't get any gas. That's how cotton works. I should actually follow cotton. See, it was one of those New York markets or New Orleans and all that fun stuff. Didn't really work for me, you know, because Minnesota. I mean, if I'm going to, you know, when I kind of got into this market, it was, you know, Peter Lynch, you know, what's in your backyard? Well, I can see corn and oats and, you know, moo cows and all this other fun stuff. You know, cotton, it's, you know, one year, you know, one part of the year, they're telling you it's a drought, the worst drought ever. And at harvest, it's a bumper crop. And you're like, okay, enough of that game, you know. Hey, we've all played the listen to the news and get it all wrong game before. That's the whole deal. You too can be a hedge fund manager, but the key is to take your money and throw it in there. Oh yeah, we'll entice you to, it's real easy. You'll get you'll get everything you want. And then it doesn't really work out that way, does it? All right, so here Goldman Sachs index, blah, 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 yada, 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 up in here, yeah, whatever. It leans with energy, so I'm going to assume it's going to come back below 300. And that's the end of that story. Wow, I went rambling through all of this. Well, I'm going to take myself a break here. Where's my Mexican peso? Oh, yeah, we already did the Mexican peso. So I suppose looking at this and running through this real quick here, watch cotton. It's in a larger sideways thing. Skip the lumber for now. Cocoa is probably just a bear bounce. Coffee, eyeball it for anything under $1.50, but look for it during the recession to go under $1. But I might have one of those where it takes off. Remember it's counter seasonal here. It's down. Watch sugar, but short term, there's some bodies in there. Obviously sugar didn't have the party that it did before. Watch orange juice special situation that just goes completely insane to the upside with some sort of Florida freeze. Canola, play the short side. What's this? Rough rice, sideways down. Oats, I'm going to say sideways down for right now. I'm saying that I think the little grain things are going to be failure, except for maybe wheat. I guess I'll have to throw oats in there with wheat. I lean bullish, but basically we'll just say sideways on here. Same thing, sideways on the wheat here. It's one of those where it's like, just don't get too giddy in there. Corn, if I can get through 2017 here with bumper crops, then I'll, yeehaw! That's how I look at it. But going back, in Minnesota, the rivers were high. So I have to face the fact that this could be the year of the drought, not next year and the hard freeze. So even though I look at the cycles of weather and go, okay, this is our window. The greed part of trying to get it in at a 35-year low or a 40-year low might not happen. Bean oil sideways to down, soybean meal down, beans down, milk. Hedge a third at 19 and hedge another third at 21 because you're trying to go into a drought. Hogs on any pullback, get in the hog business. Yeah, right. Smell that? That's money. Feeder cattle, long feeder, short live, natty gas, buy the dip. Get ready for it. Buy the dip. Gasoline short. Heating oil short, gasoline short. Short all the energies through February, I'll say. Crude oil, yeah. Dollar for pause. And then go with it again when it goes back through $1. Mexican peso, probably the best trade of 2017 on the long side. Aussie dollars, we'll say down. Canadian dollar, we'll say it'll trend higher. Maybe 80 on the Aussie dollar. I just pass. I have all these to choose from, right? British pound, look for longs and crosses. Yen, look for the U.S. dollar to unwind. The carry trade to unwind is basically how I look at it. Possibility of, who's looking for 1012, 110, 111, 112, 113, that kind of thing. What's up in here? Well, who's looking for 109 to 111? Who's looking for, if this fails, we get the reversal and it swings the other way. Swissy, any strength, short it. Copper, I'll avoid since I stomach twitched while giving a report and didn't say, oh, well, it did break out with the sideways channel, but since I don't trade it, you shouldn't carry either. Which was, hey, this is a new venture for me, right? Just so now I know I just say it how I say it. You know. Palladium. We'll treat it as a head and shoulders for right now here. Platinum, the unbalanced volume bodies are out of it, so it could be, you know, maybe a long platinum, short palladium type deal. You know, yeah, maybe that way. Long gold and platinum, short palladium and silver, I guess, maybe as a spread. Gold, we'll just see it, but, you know, eventually I think it's going to come back down to this way. Euro dollars on any strength, short it. We're looking for 5% here. 100 would be 0 interest rates, so 95 would be 5% interest rate. These are T-bills. Euro dollars are like T-bills in Europe. You watch the TED spread for when there's anything. Notes, short any bounce here in the first quarter. Same thing. Anything on the front end you want to short on any bounce in the first quarter here. No, it's the same thing. Volatility, hold on for like 24 to 26 for now. You know, once it hits, I'm sure I'll be contacting you. Short side of Australia here. Russell, same thing. We'll just watch the bottoms. The stock markets are 8 years into this here. DAX waning, Japan waning. You know, this one utilities head and shoulders. We'll say transports. We'll call it a double top. I'll have to do those indexes, and the Dow is being. To my eyes, it's only going to double. Stock market's going to double. So if you can find a double somewhere else, you know, over the next 7 years, take it. You know, I'd kind of avoid equities for now. If it craters, I mean, if we can take a third or half out of the market, then I'll revisit it. I mean, this is how I'd like to see it play out. The whole NIXON thing. Stocks, the S&P falls to 1,600, goes up to 2,400, and then goes to 1,200. And then I'll be a happy camper. They're like, hold on a second, let me write this down. What did he say? S&P falls to 1,600, goes to 2,400, and then falls to 1,200. I'll take that. S&P, same thing. We're all waiting for 230. Okay, so there you have it. I'm going to post this and go have lunch. Talk to you later. Bye-bye.